Did you know that some of the best investments in history, the ones that right now you wish you would have bought 10 years ago, actually have some of the worst drawdowns, meaning some of the worst short-term experience of any investment out there? And it underscores one of the most important attributes of being a successful investor, and that is discipline. I want to help you become a better investor. I've got that and more coming up. Okay, a brief story that you didn't ask for. When I was just starting my career as a financial planner almost 25 years ago, I was infatuated with the stock market and I was such a nerd and I was really into stock options as well. And so what I did is I created my own investment strategy, my own trading strategy, and it included buying an individual stock that met certain screens and then also buying some options to help manage the risk, but also get some income. And guys, it was fantastic. It was actually like the track record was pretty incredible. And so here's the punctuation, okay? I needed some more dollars and I was like transferring some dollars from one account to another. And I worked a little bit through school and so I had some money. And so I was transferring some money over so I could have more resources to execute this trading strategy. And along the way, I was running my screen to see which individual stocks kind of met my criteria and that I would like. And there was one day, I'd been doing this trading strategy for a few months now. And one day, ran the screen and a fledgling but well-known company made the list and named a company named Apple. Now this was, I believe it was early 2004. So this is before iPhone, even discussion about iPhone. This is before iPod Nano, right? And I'm not talking about the iPod that looks like a phone. I mean like the little one. So it's before all of that, but it made my screen and it was like, okay, well, I'm going to buy the stock then when these dollars transfer over. A couple weeks go by. Oh, there's a problem with the transfer. We need a new form. Oh, okay, fill out the form. This is 20 some years ago. So this is, you couldn't do it online. Okay. Fill out the form, send it in, another few weeks go by. Oh, but then something happened. We need to go through it and do the whole thing again. And guys, it took 3 months for this extra few $1,000s to be transferred over. And by the time it did, the Apple stock had doubled in value. And it no longer met my screens. And I said, too expensive, not gonna buy it. Do you know how much money had I invested in Apple, or any of us invested in Apple in 2004, how many zeros would be added to that number? Like what that investment would have grown to over the past 22 years. Oh my goodness. And the truth is, many of us, or let's say all of us, have those investment fish stories, right? Oh my goodness, I caught this huge bass, or oh, I almost caught this thing and it was enormous, the size of a whale. And if you don't have those investment fish stories of your own, certainly you can relate to the fantasy, the thought of, I should have just bought Bitcoin as soon as I heard about it, or why didn't I buy Nvidia, right? We can all relate to that because those are some of the most phenomenal investments. But the reality is, those investments also experience some of the most heart-wrenching pullbacks, and it's likely for me and for you that at some point you would have tapped out and said, nope, I got to get out. I had built so much wealth so quickly in this one investment, and now the roller coaster is crashing. No way, get me off of this ride. And I know that because I've had those conversations with clients who have ridden that ride. And therefore, even though it's fun to think about, oh my goodness, what if I would have bought Apple 22 years ago? I probably would have sold it, right? I probably would have sold it at some point. So take a look at this chart. I just grabbed some random names, some big names, and I think any one of us would have said, oh my goodness, I would have loved to have bought that, 10 years ago or 15 years ago. So we've got Nvidia, we've got Bitcoin, we've got Tesla, Apple, Google, and Amazon. And just over the past 10 years, look at that cumulative return. Unbelievable, right? Amazon, which is a fantastic company, obviously, competes with Walmart and, the stock's on a different trajectory. That one's the worst performer, only up, almost 700%. Google, an unbelievable company, only up 700%. But look at those others. Nvidia's up 26,000%. That's unbelievable. Any one of us would have said, oh, if only I would have. But guys, it's not straight up. It's not a straight line, even just over these past 10 years, let alone after, from their inception. It's not a straight line. This shows the max drawdown. So the biggest drawdown from a high point to a low point in the same past 10 years. And by the way, some of these have experienced worse drawdowns since, and this only goes to just recently. Obviously, Bitcoin is in one of those drawdowns right now as well. But I mean, guys, Bitcoin was one of the highest cumulative returns, 83% decline at one point. And you might say, I already know that, it's so extreme in Bitcoin, that's something. Tesla, again, one of the top cumulative returns. Any one of us would have said, if I could only have bought Tesla and a ton of it 10 years ago, that would have been amazing. You would have experienced at one point, you would have lost 3/4 of your money. And I know, and here's the heart-wrenching part is you would have seen so much money grow, and then it would have evaporated, and you would have thrown up, and then you would have said, oh my goodness, I need to sell this. And so Nvidia, right, that was the highest performer. It had its worst peak to trough was just a couple years ago, where it lost more than half of its value. Amazon losing half of its value, Google almost half of its value, Apple only losing 40%. But this isn't just an individual stock story. It's more extreme with individual stocks for sure, okay? It absolutely is. But some of the best investments experience some very extreme drawdowns. So even though all of our own investment fish stories of had I just bought this individual stock and held it today, I'd have been, a gazillionaire. The reality is you probably would have sold it, but that doesn't mean, well, then the principle is lost, the principle of discipline. Take a look at the biggest drawdowns of the S&P 500, and this is just going back to 1950. We all know, right, that the drawdown during the Great Depression was even worse than that. But the S&P 500, that again, any one of us would have said, that's a fantastic investment. If I could have just bought the S&P 500 and as much of that as possible in 2004, wow, I would have been, I would love it, right? But take a look at these enormous drawdowns from the S&P 500. Of course, we have the great financial crisis. That was over a 50% drawdown, just surpassing the tech bubble. Both of those in my career, by the way, approximately 50%. In the early 70s, approximately 50%, and then several in the 30s. Think about it. Think about your investments right now. Likely, if you're following a diversified, approach, likely, especially over the past 5 years, you would say, gosh, why do I have this diversification? I just want the S&P 500. And the S&P 500, imagine how your portfolio right now, imagine what you would do if the portfolio lost, say, 40% of its value, right? What would you do? Even the best investments, which I would argue the S&P 500 is, it is a market cap weighted index, meaning the bigger the company, the bigger proportion of the S&P it has, and that means the best performers, because the market cap is so big, become an even greater share of the S&P 500 from an investment standpoint. Yes, that creates concentration, but what a wonderful investment that does that, okay? Even that investment, that fantastic investment, can have enormous downsides. You need the discipline. Here are the takeaways then to make you a better investor. Number one, in order to be a successful investor, it does not require that you get in and then you get out and then you get back in, right? It doesn't require that. I mean, going back to that first chart, any one of those, if you just said, all right, over the past 10 years, from the beginning of 2016 until 2026, look at those returns, right? That any one of us would take it. And even just the S&P 500 over that same time, we would take that return. Being a successful investor doesn't mean that you get in at the right time, you get out at the right time, and then you get back in at the right time. You've got to be right at least twice, right? To get out at the right time and then get back in at the right time as well. Being a successful investor doesn't require that. That's number one. Number two, and this is what I started with, and the second chart illustrates, in order to be a great investor, you do need to have discipline. You do need to have discipline, that even the best investments are going to have difficult times. And so having the discipline to say, no, I'm staying the course, I'm riding through this, even though the headlines are noisy, everything's red, I've got discipline and I'm riding through. Third takeaway is even the best investments right? And this is illustrated by all charts, but especially that last one with the S&P 500. Even the best investments are going to have time periods that shake your confidence, that seem in the short term, this doesn't work, this was a bad idea. Even the best investments will have those time periods. And therefore, takeaway number 4, even though at the time diversification doesn't feel like it's working and you won't like it, over the long term, it is a very, very practical strategy for most investors. Does that mean you shouldn't own individual stocks? That you shouldn't own Apple or Amazon or Google or Tesla, or right? We've got some really big IPOs coming, that you shouldn't own those. No. I'm not saying that. Be aware of those risks. But when you're building wealth and then trying to preserve that wealth, diversification, not just of individual stocks like an exchange traded fund will have, but also of different asset classes, large cap stocks, large, mid, small, US, international, having a diversified mix. And then for us, diversifying your strategies as well. So you've got strategies that are all long, hate to say that, but then you've got ones that are also hedging, so can advance, but also have some downtime protection, multiple strategies as well. Individual stocks can make sense for a lot of people if you're a trader, but if you're a long-term investor and you still want some individual stocks, small portion of your portfolio, or consider play money. So what's your individual stock fish story? I want to hear it. Was it, oh, you almost bought Bitcoin? I think a lot of us probably share that. Was it, I almost bought Apple, Nvidia? I want to hear it. What's your experience as well? Your investment strategy, implementing these 4 takeaways, these 4 principles. Work with your certified financial planner on that. If you don't have a CFP on your team, contact one of my team. Find us online, Korhorn.com. That's Korhorn with K. WiseMoneyShow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.